Ladies and gentlemen, it looks like with a rising cost of living, with surging inflation, with consumer sentiment falling, and with debt at record levels, it looks like what is happening right now, the middle class has finally hit their tipping point. So, in today's video, I'm going to go over the news, the facts, and the data that are showing how bad things are really getting for the middle class. And people, please heed this warning. It is time to prepare now because unfortunately, I think things are going to get much worse. So let's not waste any time, ladies and gentlemen. Let's get straight into this article because I think this greatly summarizes it up. And I've also got some data to summarize the situation we're in. So I'll flip to this article here. American consumers are starting to hit their breaking point. US households have recently mostly absorbed higher prices on everything from coffee, chicken to clothes, helping companies maintain flat profit margins despite higher inputs. But that doesn't mean consumers were happy about paying more for the same goods, which is why the University of Michigan's sentiment index has steadily deteriorated to the lowest since 2011. And that's exactly what we've been talking about on the channel, everyone. We've been talking about how the cost of, food essential items like food energy is skyrocketing, and it's going up much faster than the CPI. And Shadow Stats has real inflation at around 17%, and now we're starting to see this reflected in the consumer sentiment data. So let's carry on and see what else they're saying. The line from the bulls has been to watch what consumers do, not what they say. And for the most part, the bulls have been right about consumer spending, which is why many investors remain positive on stocks and riskier parts of credit markets. Although Americans have gripped about higher prices, they've kept buying goods and have increasingly gone out to eat and started traveling as the pandemic waned. And the reason why I think that is, again, people, is because I think people have had these stimulus checks, they've had excess savings, they've been able to withdraw money from their retirement accounts. So they've had money, they've had excess cushion to go out there and spend. And also, I think this is a bit of FOMO. I think people have just been cooped up and they've just been dying to get out. I know I've been really dying to get out, dying to go on holiday, dying to see family again and go out with family. So I think this is what's kind of come in, and also this lifestyle inflation creep where people have got used to the lifestyle of living on these stimulus checks, and maybe they've gone out more and they've got used to that, and now they're wanting to keep doing that. But the latest surge in inflation, stemming in part from rising energy prices as a result of Russia's invasion of Ukraine, has pushed many households to the breaking point. Energy prices have surged about 26% over the past year, while food costs have jumped 8%. That, again, people, is absolutely crazy. Energy prices up 26%. Do you think people are going to be able to afford this? And they say food prices are up 8%, but I'll get into later in the video, the new data we're getting, it's showing that energy prices and food prices are going up much faster. These two inputs account for more than 20% of household outlays, he wrote in March 23rd research note. So again, people, consumers, a lot of their money goes on energy and food. Meanwhile, big increases in house prices and recent increase in the 30-year mortgage rates to 4.5% from about 3% last year has pushed home loan repayments as a percentage of family income to 22.4% on average for new buyers and 18.4% for existing buyers. Now, I don't know about you, but again, for people wanting to buy a home right now, especially for people on the average income, I'm thinking they're having to spend much more than 22% of their income on housing. I've seen people spending all the way up to 55% on housing with either higher mortgage costs, or we're seeing in many places like in Florida, Phoenix, etc., Texas, rents are surging in some places by 30%. They also calculate that housing affordability is at its lowest since 2007, with costs an estimated 15% higher in March than December. Look, what also is happening, everyone, retail sales data has been resilient on a nominal basis, supported by inflation. So the trick there is they're saying, look, in number figures, nominal terms, retail sales are still good. That's just because people are actually spending more. But in real terms, people are actually spending less. The only reason why the nominal numbers or the number of retail sales is higher is because of inflation. But look at unit sales of general merchandise. Goods such as apparel, footwear, toys, and sports and equipment dropped in 9 out of 10 weeks between the end of December and early March. On a year-over-year basis, according to our MPD group data, the report noted that 43% of consumers recently surveyed said they would delay less important purchases if prices keep going up. So what this means, everyone, this means I think what's going to happen in the future is, yes, people have been able to pay these higher prices now, but I think the prices are going to continue to accelerate, and we are going to start to see some of this retail sales drop. And again, we'll get into what's happening with people's savings. So look at this chart here. This is the Fed personal savings rate. Now, this is why there's still so much pent-up demand, because look what happened in April 2020 when all people got those stimulus checks. The savings rate hit an all-time high of 33% of income. Then again, when they got more stimulus checks in March 2021, and that's when we saw the markets go crazy, the savings rate hit 26.6%. But look what it was in 2019. It was around 7 to 7.5%. But look where we are now. We're actually now lower than we were in 2019. It's now down to 6.3%. And that's simply because consumers, they're having to use all their savings to keep up with this rising inflation. So yes, maybe they can last 6 to 12 months, but if inflation keeps rising, you as consumers, they're not going to have any cushion or any savings to keep going through. And listen to what else is happening. Analysts expect this trend to show up in Thursday's personal consumption data, with the pace of increased spending expected to lag behind the inflation rate. So let's have a look to see. I've got the personal consumption data here. Listen to this. The Fed's preferred inflation gauge, and again, the reason why they prefer it, because it's the lowest, rose 5.4% in February, the highest since 1983. So look at this. Including gas and groceries, the headline PCE measures jumped 6.4%, the fastest since January 1982. Now, the surging prices dented consumer spending, which rose just 0.2% for the month, below the 0.5% estimate. So what that means is these economists, they're putting out these estimates, but the data is actually coming in much lower than they thought it would happen. Disposable income increased 0.4%, a touch below the 0.5% expectation. But real disposable income, remember, what you have to factor in is, say, for example, if you get a 3% pay rise, but inflation's 5%, or now it's actually 8%, well, you're actually losing money. So it says here, real disposable income actually fell 0.2%. Now look at this. This is very, very worrying, everyone. However, energy prices jumped 3.7% for the month before abating in March, while food inflation rose 1.4%. That is absolutely terrifying, people. When you annualize that, and remember, it compounds every month, if this rate kept up, that'll be an increase of around 44% for energy prices to go up, and around 17% for food costs to go up. And do you think the average American or the middle class, this is happening global, everyone. So it's happening everywhere. And it's happening in Australia, Europe, Canada, etc. Yes, the middle class has been able to, hold this up with these savings to cushion them. But simply, I don't know how they're going to survive the next 6 to 12 months. We've already seen Joe Biden come out and he finally admitted what I've been trying to warn people about here on the channel, that food shortages are coming. He's finally admitted it, but maybe it could be too little, too late. It says here, consumers are whittling down cash piles built up during the pandemic. Even if the rate stays the same, it may indicate that the days of prolific pandemic-era spending are over. So the shift among consumers has been subtle, but that has consequences amid the monetary and fiscal policy tightening that is currently happening. The last time consumer price inflation was as high as it is now, the more consumers push back on higher prices, the bigger ripple effect throughout the economy. Companies will see their profit margins shrink, diminishing their appetite to expand, invest, or hire new people who are demanding substantially higher wages. So people, could we start to see this affect companies' earnings or profit margins? Because what happens with inflation, if people earn more and the cost of everything goes up, maybe their revenue will go up. We'll have to see what happens with their profit margins here. So it says here, this isn't a reason to sell stocks or high yield bonds outright. Many companies still have high cash balances, and they have taken advance of buoyant credit markets in recent years to expand their debt maturities at historically low interest rates. And we can also thank the Federal Reserve there, because what they did in 2020 was something absolutely unprecedented. They actually started buying corporate bonds, and they also set up credit facilities. So if any companies needed credit, they would just lend to them they snap their fingers, they say I need some cash, and the Federal Reserve will give it to them. The longer consumers rein in their spending in response to the highest rates of inflation since the early 1980s, the more difficult it will be to emerge from the recession that seemed increasingly inevitable. And we've also now seen the 2-year and the 30-year invert, the 2-year and the 10-year invert. So if history's any lesson, then we are going to enter recession soon. As we now know, recessions resulting from sudden shocks, such as the COVID-19 pandemic induced in 2020, can be reversed or offset extremely loose monetary policy and extremely generous fiscal policy. We may be about to find out that recessions born out of stagflationary shocks are harder to mitigate. And that is a question, everyone. What can the Federal Reserve do? They were able to, print huge amounts of money during the 2020 recession, during the 2007 recession, because there wasn't much, inflation. But during stagflationary times of high inflation and low economic growth, what can the Federal Reserve do? They're pretty much stuffed either way. What I think they're going to do, unfortunately, what's become more obvious, they're going to let inflation run hot. They're probably going to U-turn eventually after they do a few rate hikes, and they're going to turn the money printers on again once the economy does enter recession. They're going to sacrifice the middle class to save the markets. So this is why I've been going back into the markets, because I think it's quite clear that the Federal Reserve is going to choose Wall Street over the average American. And this is just a way to protect yourself against this inflation. Obviously, you want to get your food and all your prepper items before they skyrocket in value, but I've already done that. That's why I'm now dollar cost averaging into the markets. I'm also still holding gold. I'm not, selling all my gold. I'm still holding that as part of my portfolio and diversifying into cryptocurrencies as well. It's not financial advice, just what I'm doing. But everyone, that's just some of my thoughts on this article. I thought this summarized it very well, what's really happening with the average consumer and the middle class right now. But what do you think? Let me know. Now, for all my loyal viewers and subscribers still watching, you are awesome. Thanks for watching. I'll see you all in the next video.